Hi everyone, and welcome back to my YouTube channel. Today I'm going to talk about two stocks, which are Verizon and IBM. That's not something I was planning on, but one of my YouTube viewers asked me to analyze those stocks and create video, and I thought, why not? So I'll just share with you my thoughts on it. I'll go through some of the financial data of those two companies and give you my thoughts whether I would buy them right now or not. To start, I would like to step back a little bit and just talk about what would I consider to be a good company, right? What kind of qualities I'm looking for if I want to buy something right now. Well, because I'm more of a dividend investor, I'm interested in companies that pay dividend. So I would be looking at their dividend payout ratio. But there's a lot more to the company than the dividend payout ratio. Because after all, the company could be paying 5 or 10% in dividend today, but they could cut it tomorrow. So it's very important to look at how company doing financially. Can they afford that dividend? And whether the company is growing their revenue or not. How profitable the company is. Because after all, even if the company is currently paying, let's say, 5% dividend, but their sales are declining, well, that will be reflected in their stock price eventually. And quite often it will be more than just 5% a year decline. So I think it's important to look at overall history of the revenue, whether it's increasing, even if it's slowly over time. Look at how much profit they make and if the dividend is sustainable or not. So let's look at the IBM company first. Let's look at their stock price for the last year. Here you can see their price stock have increased by 5% compared to what it was 12 months ago. But overall, if you really look at that graph, you can see that the stock kind of jumps up and down a little bit, but really not going anywhere, right? Because in the middle of the year it was up and then it started dropping again. Now it went up again a little bit. So it's kind of up and down, really. Let's look at Verizon for the last year and compare the two. Well, in some ways this looks even worse, to be honest, because Verizon stock for the last year is down 16%, and you can see it just steadily going down. On the other hand, the dividend is nice 5%, and the PE ratio is only 9.44. Compare that with the IBM's of 23. Let's dive a little bit more into it. Let's look at the cash flow for the IBM. You can see that the net income was almost $5 billion. The dividend payout was actually over almost $6 billion, which means what? Means that the current income doesn't support those dividends. That means it's not really sustainable in the long term unless they increase their revenue as well. Right here you can see that their current payout ratio is 126%. That means that they paying out more what they're bringing in, and obviously it's not sustainable. On the other hand, let's look at the Verizon. Verizon payout ratio is pretty low. It sits currently at 47.4%. So it's more than sustainable, at least in the short term. Here's another interesting graph. You can see that overall, IBM revenues are basically falling. You see, it's going down. It's going down quarterly, trailing 12 months going down. And if you look year over year quarterly growth, there's a lot more red than green. If you will look at the similar graph for Verizon, it looks a little bit better. The growth is there, the trailing 12 month, the quarterly growth is there. And year to year quarterly growth, we can see a lot more green than red. So what that tells me is that even though the stock price is not reflecting it, but the Verizon seems to be doing a lot better than IBM. That could be simply because people expect or hope that IBM will turn around and start producing more profits. Who knows what it is, right? But at this point, clearly, if you simply look at the graphs, Verizon doing a lot better than the IBM. Here you can look at Verizon dividend history. You can see that at 2015, they were paying 2.22 per share, and every year they seem to be increasing their dividend. because of the fluctuation in the stock price. Right now, Verizon actually paying the highest dividend it's been in the last 5 years, while the payout ratio is actually the lowest. Because if you look back in 2015, they were paying, well, almost the same, 5% dividend, but the payout ratio was 90%. And it actually seems to be going down. Well, except right here, right? 2018, the payout ratio was actually 30%. But that can be expected from a business, right? I mean, revenue fluctuate. There could be, spending some of the revenue on building new infrastructure. But I actually like it, to be honest, that overall the payout ratio is going down while they're increasing their dividend. Now, this is just looking at the numbers, but you have to really think about the actual business model and what do they produce and what the future has for them, right? Many famous investors, such as Warren Buffett, Peter Lynch, talk about how the best stocks to invest in, the best companies to invest in, the companies that you understand their business, and that you're familiar with it. That's one of the reasons why Warren Buffett never invested in .com companies in 1999, 2000. And for a while, everyone was thinking that he's missing on a lot of things and that he's not a very smart investor. Things turned around when 99.9% of those companies crashed and burned. I myself actually work in IT, so I'm a little bit familiar with IT companies. And to be honest with you, I don't actually see the future for IBM because I don't deal with them at all. Like when I'm saying at all, I mean zero. They used to create hardware. They had like PC line, server line, but they sold those out. I know the computer business they sold to Lenovo, which is a Chinese company, and now they're concentrating more on software and the services. The problem is they don't have anything. They don't actually have any edge. They don't have anything that makes them unique. For example, in the last 3-4 years, a business that really been growing a lot for Microsoft and for Amazon is their cloud division. They're basically making a lot of profits on it and it's growing like crazy. Well, if you look at the market share for the cloud business, here's some of the top competitors and their market capitalization. You can see that Amazon is a clear winner with 32%. Azure, which is basically Microsoft, is second at 20%. Then there's Google at 9%. Then Alibaba at 6%. And then IBM is number 5 at 5% of the market share. I mean, that's very low. When you want to invest in companies, you want to pick companies who dominate in their field. Or at the very least, number 2 or 3, not number 5. Because as you can see, number 5 here, the difference between number 5 and number 1 is not just a few percent. Amazon is sitting at 32, IBM sits at 5%. And as Amazon and Azure growing, well, they're going to get the market share from somewhere, and most likely it will be from a smaller companies like IBM. Like I did a little bit of reading, and basically IBM Cloud is not very popular, and one of the reasons is because you actually need to hire IBM specialists to help you implement IBM Cloud. Whereas with Amazon and Azure, you pretty much just sign up and you can do everything yourself. As I mentioned, you want to buy companies that are growing, not shrinking. Here's the history of IBM stock price compared to S&P 500 price. You can see that as S&P 500 keeps going up and up and up, IBM basically just slowly going down. Here's the price for Verizon stock. Very similar story. What you want to see is something like this. Very boring stock, Procter & Gamble. What do they make? Soap, toothpaste, laundry detergent, dish soap. It's as boring as it gets. But as you can see, the price for the stock is pretty much keeping up with S&P 500. What I do like about it though is right here, you can see that it's a lot more stable than your average S&P 500. When the coronavirus hit and the stock crashed 40%, you can see that Procter & Gamble went down a lot less. So basically, it's a lot less volatile. And that's what I want in my companies. Because it's very hard to predict when the next crash will happen. And the last thing you want to happen is economy is bad because market's bad, you may lose your job, this, that, and then on top of all of that, you lose 60-70% of your portfolio. So I actually like the fact that it's a very stable company. It doesn't move very much. It may not go up as much as S&P 500, but it's also not going to drop as much. And here's, of course, the look at Microsoft, which in the last few years done phenomenal, partly because of their cloud computing. And what sets Microsoft, for example, aside from IBM, is the fact that they have a lot of other products that they can leverage. For example, their operating systems, they have a monopoly. 80% of desktop operating systems are Windows, and I believe something like 90% of server operating systems are their Windows servers. And on top of that, they have productivity tools such as Microsoft Office, which basically pretty much every business in the world is using. And right now they went to subscription-based model. That was a few years ago, and they're really pushing it. And once you subscribe to it, it's very hard to move to something else. Recently, I seen an article that they're raising their price on a subscription by 20%. Well, that's for a monthly subscription. So they want people to subscribe for a year, which gives them very predicted revenue. And that reflects in their stock price. Like, it's just unbelievable if you look at it. The stock went up basically 450% in the last 5 years. To be honest, a few years ago, I was thinking of buying Microsoft, and I thought, well, they're kind of expensive. Maybe I'll wait, right? Because they just keep going up and up. Well, they have to go down. But when I started analyzing their revenue and stuff, I realized that they may not go down all that much, because there is a reason why their stock price going up so much is because their revenue increasing a lot. And so I did buy Microsoft, I don't know, about a year ago or so, and I've been buying up more here and there. So here's another graph that I found that I think is interesting. The wireless subscriptions market share by carrier in the US. Well, you can see that the blue is the Verizon and the gray is AT&T. And you can see that about 6-7 years ago, Verizon was the largest carrier in the US. But it seems to be changing. If you look at the last few years, Verizon seems to be losing market share to AT&T. So that could be one of the reasons why their stock is down, even though their profits are up. Because don't forget, a lot of the carriers, they kind of almost working together, and if you look at their pricing and stuff, almost everybody offers the same price. After all, they're all in the business to make money. They don't want to give their products away. So they all like to raise price together, and sometimes they drop it as well. And because of that, they have a little bit of control of their revenue. They can raise the price when they want to. So now that we looked at all those graphs, at this point I'll give you my final thoughts on IBM and Verizon. When it comes to IBM, I would not buy them. I wouldn't even think about buying them, because I believe they don't really have a future. I don't see anything that gives them edge over other companies. And if you look at the history, I mean, they slowly dying out, really. They sold their computer business to Lenovo years ago. They're trying to concentrate on software, but even that, they have to compete with other companies that have a lot more to offer. The way I see it, they have nothing that they can offer compared to, let's say, a company like Microsoft. Right now, their revenue actually went up a little bit, but in part because of their cloud services. But like I showed before, their cloud services, the market share is only 5%. And I believe eventually they're going to even lose that. And if you buy in IBM for their dividend, well, they don't actually generate enough profit to cover that. Their payout ratio is 126%. On the other hand, Verizon might be a good choice if you looking to invest in a company that pays dividend to have that passive income. Even though lately Verizon have been losing some market share to AT&T, I don't really think they're gonna go out of business anytime soon. Their profitability seems to be growing. The payout ratio currently sits at less than 50%, and that's with paying out 5% in dividends. I actually own some Verizon stock. I bought it about 2 years ago, and I was even thinking of buying a little bit more. But after I did research for this video, I'm not so sure I want to add to my position in it. I don't know, I'll have to think about that. But definitely, if you don't actually own Verizon yet and you're interested in solid dividend payment, yeah, I would consider it. Simply, if you already own it, there is a lot of other companies out there that I think a lot better choice. I hope you like my video. It will be helpful for me if you click the like button and subscribe. Then you'll get notifications for my new videos as well. And as always, happy investing. Take care.